Hello friends, welcome to AKS. Today we will deal with the weekly current affairs roundup of economy for the first week of August. Now let us look into this editorial stating governing India through fiscal math. What is the context? While it is important for a government to pursue a sound economic policy, including management of public finances, it is yet another matter to make a fetish of any one aspect of it. The latter appears to govern this government's approach to policy when the fiscal deficit is given pride of place in its self assessment. The government has committed to the path of fiscal consolidation under the FRBM Act. Under this act, the government has targeted to reduce the fiscal deficit to 3% of India's GDP. Let us look into the further details. The fiscal deficit by alone may not provide a true and complete picture of the government finances. Both fiscal deficit and revenue deficit are required to be lower for efficient management of public finances. So the author states that instead of restricting only to the parameters of fiscal deficit, the government in its policy formulation should look into fiscal deficit as well as revenue deficit as parameters to devise a sound economic policy. Presently, the fiscal deficit for the year 2018-19 financial year is 3.4%, while the revenue deficit is 2.2%. Thus, the revenue deficit accounts for around two-thirds of the fiscal deficit, which shows that some of the government's borrowings have been diverted towards meeting the operational expenses. Now let us try to understand what do you mean by fiscal deficit. It refers to the overall borrowings of the government for the current financial year. The money borrowed by the government can be used for both revenue expenditure as well as capital expenditure. Okay. So, to explain in simple terms, fiscal deficit is equal to the total budget expenditure minus the total budget receipts excluding the borrowings. So, by this formula, you can know what is the present fiscal deficit of the government. Generally, fiscal deficit takes place either due to revenue deficit or a major hike in the capital expenditure. What is capital expenditure? Any kind of expenditure by the government which creates long-term assets. What is revenue deficit? It refers to the deficit on the revenue account which is bridged through borrowings. Okay. So by now I think you understood what is the thin line of difference between fiscal deficit and revenue deficit. So in the present context, as we have seen, the fiscal deficit is much higher than the revenue deficit, which implicates that the government's borrowings have been diverted for operational expenditure. So what are the main implications of this? It leads to increase in public debt. It also leads to higher borrowings by the government to meet our operational expenses. Also, intergenerational inequality will be an implication of the present situation. That is, in order to repay the present borrowings, the government has to resort to imposition of higher taxes on the next generation. So these are the present implications of the revenue deficit being much lower than the fiscal deficit. Thus, reduction in the fiscal deficit by the government may not provide a true picture, since such a reduction may be brought about through the reduction in capital expenditure, which is undesirable in the long term, because it is the capital expenditure which creates capital assets, which in turn are required for the long term sustainable economic development of India. Further, the government has recently announced in the budget that it would borrow money through the issue of overseas sovereign bonds. So, try to know about what are these overseas sovereign bonds and what implications does this step have on Indian economy. The next editorial deals with RBI relaxes ECB end use policy to boost economy. What is the context? The Reserve Bank of India has relaxed the norms for end use of money raised through external commercial borrowings. What are these external commercial borrowings? ECB is a loan availed by an Indian entity from a non-resident lender with a minimum average maturity. Okay, they are used widely in India to facilitate access to foreign money by Indian corporations and public sector undertakings. So, let us look into a brief background about ECB and its operation in India. The Reserve Bank of India had drawn up a new external commercial borrowing framework in order to further improve the ease of doing business in India earlier in the year 2019. RBI has also eased end use of ECB proceeds to allow companies to raise foreign funds via the approval route from all eligible lenders except from overseas branches and subsidiaries of Indian markets. There could be a question in your prelims examination giving a statement that ECB's RBI has given approval through ECB route for overseas branches and subsidiaries of Indian banks, which is not true. Okay. So let us look into this editorial stating transforming livelihoods through farm ponds. So we will try to know what are these farm ponds, what are the context in which they have been introduced, and what in which way do this farm ponds transform the livelihoods of rural people. What is the context? With an increased variability of monsoons and rapidly depleting groundwater tables, large parts of India are reeling under water stress. Also, a number of peninsular regions like Bundelkhand, Vidarbha, and Marathwada have been facing recurring drought like situations in India. Given the enormity of the crisis, at a recent Niti Aayog meeting, the Prime Minister explicated the need to implement innovative water management measures, stressing particularly on the importance of rainwater harvesting both at the household and community levels. Okay, so let us look into how farm ponds can be cost effective structures that can transform rural livelihoods. They can help enhance water control and contribute to agricultural intensification and boost farm incomes. This is possible only if they act as rainwater harvesting structures. They can also act as recharge points, contributing to the groundwater replenishment. These farm ponds can help in providing supplemental irrigation in the Kharif season and an enhanced irrigation coverage in the Rabi season. These farm ponds can retain water for 8 to 10 months of the year. Thus, farmers could enhance the cropping intensity and crop diversification within and across the season. Also, these farm ponds are financially viable. So let us look into the wrong practices which could accelerate depletion of groundwater. So what are the various practices which are followed which are leading to depletion of the precious groundwater resources? Most of the ponds are being constructed with walls raised above the ground surface. As such, there is no inlet for the excess water to be harvested during the rain. Also, farmers line the ponds at the bottom with plastic, thus restricting seepage and converting the ponds into intermediate storage points. Further, the lot of ponds are being used as intermediate storage points, accelerating groundwater depletion and increasing the evaporation losses. So let us look into the next editorial explaining the Asian rate cuts wave. What is the context? The latest IMF World Economic Outlook update in July 2019 has confirmed a growing belief that the global growth has decelerated and dark clouds seem to be looming in the near term. So here you can expect a prelims question asking you the world's economic outlook update is given by which of the following international organizations, of which IMF is the correct option. Also, specifically, the IMF has downgraded global growth multiple times since October 2018 and now projects it to be 3.2% compared to what it has predicted as 3.6% in the year 2018. So what are the causes for this Global economic slowdown. China is witnessing slower economic growth due to the internal reforms undertaken by the Chinese government and the tariff war with the US. Japan has also struggled to lift its economic growth rate. The slowdown in Asia's two largest economies, namely China and Japan, have led to a decrease in market demands and therefore a decrease in imports. This has caused slowdown in the export dependent Asian economies such as South Korea, Singapore, and other countries. In addition, the US trade war has caused a major supply chain disruption for the corporates in export driven Asian economies. So, what have been the responses to this economic slowdown? The US Federal Reserve is set to embark on a new round of rate cuts, while many Asian central banks, such as of India, China, Indonesia, Malaysia, Philippines, and South Korea, have begun to ease the monetary policy, that is, they are going for a rate cut, interest rate cut. So, what is the expected result from this response to economic slowdown? This is expected to combat subdued inflationary pressures. Also, if interest rates in the US decline, emerging economies may experience an increase in capital inflows if their economy showcase ability of higher returns such as competitive interest rates, sustained forex reserves, etc. Regional currencies may face depreciation in comparison to US dollar if the lower interest rate does not lead to increase in economic growth. Now let us look into the Indian scenario in context of the global economic slowdown. India has not been well integrated with the Asian and global supply chains. Also, it has not been as impacted directly by the US China trade war. So, this is something positive in nature for India. India has not been able to effectively act as an alternative production and export platform to China, a position likely to be achieved by smaller East Asian countries compared to India. RBI has cut rate multiple times by 25 basis points since October 2018 to a 9-year low in nominal terms. Further, RBI has shifted its stance to be accommodative stance. However, India's real interest rates are still higher than most other countries and may not be competitive for capital inflows. India largely suffers from internal factors rather than external factors for economic slowdown. In particular, the banking crisis is one of the major reasons for economic slowdown in India. The non performing assets are causing high provisioning requirement, which has negatively impacted profits of India's banking system. Similarly, banks have tightened the lending to private sector and coupled it with higher interest rate of actual loans. Thus, the private investments in India has decreased, leading to overall economic slowdown. The author of this editorial also recommends that the overseas sovereign bonds, as proposed by the finance minister, is not the right solution for India to combat economic slowdown, but rather the government should streamline subsidies and revenue expenditure so as to impel the economic growth and reduce the deficit in Indian economy. Thank you. Have a good day.